Hold on. Hello, ladies and gentlemen. My name is Sasha Star. It's a program on IBM TV, POT TV, by the name Modern Investing. And would like to introduce my guest for today. It's Peter Bennett, the veteran of Wall Street. Welcome to the show, Peter. And also Nick.
Peter's not here yet.
Okay, hopefully he'll join us soon.
Yeah,
And Nick Poliveda, founder of this New York. How are you today, Nick?
I'm doing good because my stocks are up, but I'm not in
That's
those.
very good. Good news. Good news.
I'm not in those tech stocks, though, as you know, Sasha.
Well, the tech stocks will have to probably wait until things will settle down with inflation and other things. They will definitely will go up. They will have their day ahead. But right now, the concentration is for market to find its bottom. There will be some short-term rallies here and there. And it looks like market is close to finding its bottom, but probably it's not there yet. Although last couple of days were somewhat encouraging, so it's depends what's your outlook. Hello,
Hello, glad you made it. Glad
Bill Zabrak, welcome to the show.
Thank you. Glad to be here. Thank you for inviting me.
Yeah, we are discussing the state of the market today. It seems to me that the market is trying to find its bottom. I don't think it's still there.
So I don't think it's close.
Yeah, there will be short-term rallies, and then the market may turn around and go lower. Milan, what's your outlook on the market these days?
Well, I'm glad you asked. The very first trading day of this year, and I think it was January the 3rd, the S&P 500 reached its very peak, the highest it's been in history. First trading day of this year. Since that time, it's been declining steadily, and about 15 minutes ago, it entered bear market territory. Bear market is defined as a 20% drop. So in the 5 months since the highest ever to bear market, that's where we are today. And you know something? People who invest the way that we recommend are glad to be there.
Right.
Most people are not, but we are glad to be there because bargains abound. And so the market is the bargain at 20% off. So we have to keep in mind that money, which we are going to need in the next 2 or 3 years to buy groceries and pay the rent and buy a car if we're planning one and take a trip if we're planning to do so, money that we will need in the next 2 or 3 years does not belong in the market. Keeping that in mind, any market drops we see as a bargain. So we're looking for bargains all the time. You want to buy groceries at a 20% discount and buy your next car at a discount and a camera and a holiday, whatever you want to buy it at a bargain price. When the market becomes a bargain, people are heading for the doors. When the market is expensive, instead of taking profits, people are jumping on board. So that's an unusual kind of behavior, but that's where it is. So we are glad to see a 20% drop because we can use our asset allocation, which should always have a lot of cash in it, say 50-50, 50% market, 50% cash. When the market drops, we rebalance to bring it back to 50-50 by buying bargains. So I'm delighted, as our members of our program, Monday Morning Millionaire, to see the market drop, and we will be just as happy if it dropped more. And then when it rises, and that will happen, one of the certainties of the market, there are very few, one of them is that the markets will fluctuate. And another one is that 10 years from now, the U.S. market is going to be ahead of where it is today. empires have 100% failure rate. The American empire will face the failure someday, but it's still not evident. So the place to be is the American market, and the time to do it is when bargains abound. So those are
I'd like to put in the opposite opinion right now. You know, Milan, I agree with you that your approach is a very solid approach over long terms in general, and most of your ideas are very good, but this is, I believe, a very different time. And, you know, it's worked for 20 years, 30 years, and you're saying everybody's happy. First, I want to present a few things. For one, these are just some recent articles that show quite a different contrasting opinion. And, you know, you could say it's good if the market keeps dropping, but people are losing a lot of money during that process. It might be better to get in later using your approach, perhaps in 5 years or 10 years, possibly. So first of all, this is coming from Barron's Bank of America. The bear nears and might not exit until S&P sinks to 3,000. They said, based on history, there's probably a few more months of pain ahead. This is the Bank of America team. They are bearish. They said that if they looked at a study, they looked at the U.S. markets over 140 years and found the average decline to be 37%, lasting 289 days. If past is prologue, this market should bottom in October at S&P 3000. But I think I'm possibly more negative than they are, because I see this as we're in a transition period. So here's an article by somebody who's predicting this is about gasoline. There's basically saying there's requirement for the summer is 9.7 million barrels a day, but production is 9.1 million will likely be available. That's a 5%. You know, that is a very large deficit, considering last week or the week before I discussed that the elasticity is about 5% on oil. So that means for it to make up that 5% they're short, oil could go up another $100 a barrel. I have no idea, but it could easily go up another $100 a barrel. Add $3 more to the price of gasoline and see how the markets are looking then. Elon Musk, inflation is much worse than reported. So he said he's talking about the fact that it's much worse, and that's because they keep reporting the 8.5% to the consumer, but the producers are facing reduction around 11.5%. So he's saying Tesla suppliers are under severe cost pressure, with some requesting 20 to 30% higher prices for key parts. This is not good for the market. Shark Tank star Robert, Herjavec, stock market will drop 30% before reaching a bottom. So he's saying it'll drop 20 to 30%. But I don't know, Nick, if we can pull this up or not. This chart, here's your problems here. This is a chart of inflation. I don't know if we can pull it up on the big screen, but this is only since Biden took office. This is not. Now, can anybody tell me this is not the good trend? And the question is, how long will this trend continue? The Fed has very little power right now to control this inflation. It's based on labor costs, which are now spiraling. Everybody needs employees. People are paying more and more. There's not enough workers, partly because of the overstimulus. But also, the other chart I wanted to show, if we can go on this again, this is oil demand through 2050, according to the U.S. Energy Information. So if you look, renewables increase, but world demand for natural gas and liquid fuels is going up since 2050. So the Biden administration, I'm sorry, has no idea what they're doing at all when it comes to energy and inflation. I mean, this isn't a political show, but I'm just talking economics here. So first of all, my criticism is what they've done is actually increased carbon production around the world, and pollution is getting worse, U.S. and worldwide, in the last year. Why? Because instead of oil, natural gas, people are using oil. Instead of oil and natural gas, they're using coal because there's shortages of these things. So people are going back to coal. Plus, they're forcing some production to go to China and other polluters. China produces 1/3 of all the pollution in the world. So the worst thing we can do is hurt U.S. companies and U.S. energy costs, which hurts U.S. companies. So we are very likely now in an inflationary spiral like the 70s. Now, if you used your philosophy in the 70s, the bottom line, from 72 to 83, it was a very long period when you might not have been wanting to be in the market. The market did terribly during this period. Most periods, you're right, Milan, but this is a very different period. If my portfolio is down, I just want to add 4% from its high, only due to Amazon. If that, options, and as soon as those, and I think Amazon's the one place I would be. So, I mean, one good day, two good days, and I'm in the plus already for the year and for any period because I'm almost on my high. And that's because I've been saying for a year now we have an energy crisis, and for 6 months you better get out of the market. And I stay with that prediction.
You raised so many points there that I'm going to respond to one that I think is the most important one. Who benefits from inflation?
Who benefits?
Yeah. Who benefits?
Well,
real
actually,
estate,
I can tell you that.
Sorry?
This is why we're in a. This is you brought the most important point up. Actually, it's a great question. Only one thing benefits from inflation, and this is why this problem of it could go on a lot more than 10 years.
Sure.
The U.S. government has spent more money than. Let me rephrase. A lot of people believe that the deficits for Medicare are greater than all stocks, bonds, and privately held real estate combined. We are about to hit in 2026 or earlier, maybe 2024, the period when it's going into deficit. So they've been taking decades of money that have been used to, we're supposed to be theoretically sequestered, right? They're supposed to be in a pool. But the U.S. government has taken that money and they've been spending it basically stimulating the economy and not causing inflation. Because if they had printed that money instead of taking the money coming in and just put it out, then there would have been inflation before. But now they're getting, wait, let me just finish the point. So the only way they can handle this inflation coming, and the only one I could find who benefits, maybe you could think of somebody else, is the U.S. government is going to owe hundreds of trillions of dollars, very likely. And they say it's 28 trillion, but that's nothing. And it's going to be huge. And they've never paid down a dollar deficit, by the way, historically, ever. Never in history have they paid down. It always goes up. And that's not counting the non-GAAP, the Medicare. And I have to throw in too, the U.S. is not alone. The whole world is in the same situation. So they'll be printing money too. So the best thing for that situation is to have low interest rates, low returns on investments, which will follow probably, and very high inflation or relatively high. It's called stagflation. Nobody benefits except for the U.S. government, but that's the only choice they have.
One of the greatest beneficiaries of inflation is the government for two reasons. One is you lend them money by buying their bonds, and if you keep them to expiry date, you get your money back, except it buys less than it did when you lent it to them. That's one. And the second reason is, as inflation goes up and prices of everything go up, the taxes that the government is collecting on those taxes increase. So those two reasons are in place for why governments are one of the greatest beneficiaries of inflation.
We agree on that.
Very little interest in controlling it.
That's also assuming they reprice the real estate portfolios that they have, because sometimes government's a little bit incompetent, especially at the state and local level. In other words, they do valuations on the real estate and then they just don't do it for a while. So what happens is they're not collecting more taxes than they could have by doing reassessments, which today using technology is really easy to reassess your real estate portfolio, which went up significantly due to inflation, at least in my part. My personal portfolio is up. My professional is down because just when you hand money to professional, they never get out because of impending doom. They stay in no matter what the doom is. But here's the problem I have, which Sasha brought up. Okay, we know the market's now off 20%. It's a bear market. Will it go down another 20% like it did in 2008 or thereabouts? And this is the problem that I have. Jumping back in now, is it really a bargain? Or are you going to be hitting with another 20% loss like we did in 2008 when I was managing 300 pension plans And yeah, we watched the market down 20%. We kind of shrugged our shoulders, but the shoulders didn't shrug too well when the market went down near 37%. It was nearly 40%. So, Sasha, is this the bottom? Is there
Yeah,
bargains, or are the bottom yet to be found? That's my
sure,
question.
sure. I'd like to respond to you, but I also will respond to Peter's presentation. But first to you. Nick, the market is always right. You cannot fight the market. Market is always right. The only thing is what's very difficult to predict what's happened to the market in the short term, because in the long term it will go higher and probably much higher than we are here
Right.
today. So let's see, if you have $100,000 to invest right now and you think that we near the bottom or at the bottom or anywhere. Actually, the bottom nobody can really predict. So let's assume that we are near the bottom. I would invest into something what you really like and always wanted to have, but for some reason you didn't have. Maybe your wife didn't allow you to buy that stock, or something else happened. So right now, I would invest 20% of that available amount to that particular stock that you really like, and wait further. If market will recover from this point on, you invested 20%, so you will make some money anyway. Now, if it will continue to go lower, so maybe a month, 3 months, 6 months later, you will buy more. But now you will have still your powder dry. You still have available capital to play with, because remember, preservation of capital in any market is rule number 1, number 2, and number 3 as well. Now, Peter, dealing with what you presented to us. I've been in the market long enough to understand what is the noise of all the market predictor and analysts and whatever it's Baron or whatever is newsletters that you're getting in your mail from 1,500 different sources or anything like that. That's nothing but noise. I dismiss everything. I will read it. Maybe I will spend maybe a second and a half to read the headlines, but I ignore them entirely. The only good advice I've got from financial publications many years ago, it's from William O'Neill, the editor of Investor Business Daily. 2 things. Number 1, never pay the margin call. If you're losing your position, just sell it. Never pay the margin call. Number 2, which is connected with this one, if you lost 7% of any positions that you have in the market, sell it out. The end of story. Don't even try to guess, well, maybe this time I will keep it until 8% loss. And then if it will continue to go down, maybe I'll say, no, 7%. That's all what you're allowed to lose on any position. In fact, if you are playing on margin, its number is much less than that. It's not 7%. I would say it's rather 3%, 3.5%, no more than that. So you got in the position, you lost 3.5% if you're on margin, sell it. If you're not on margin, 7%, just tops. That's the end of story. Now, speaking about possible bear market and its duration. Okay, bear market, obviously we are in bear market and there is nothing new. There are several bear markets in the history of the US market. But now the speed of the decline is much faster than ever. Why? Because of the electronic trading, because of everybody, essentially everybody knows everything what is there about market, from commentators on CNBC, from all the other sources that you're using and so on. So usually decline, which normally would take years, now it's taking sometimes weeks, maybe a couple of months, 3 months, 5 months the most. There is another phenomenon. Margin calls. There are a lot, especially in the high-tech sector, a lot of retail investors flock to high-tech stocks, whether it's AMD, whether it's Microsoft. Actually, Microsoft is almost a blue chip. So I would consider many other stocks like, say, Qualcomm, maybe others. I never even talk about the garbage stocks like Snap and others that fall 40% in one day. But however, margin calls these days. I remember old times 20, 30 years ago when I would get margin call. Oh, I had 1 week to settle. Then I could call and say that I need 3 more days. I'm getting transfer from Mexico or from Hungary or from any other place, so I will get another extension, maybe a week. These days, if you have margin call, you have to settle next day at 1 o'clock. So very often market after 1 o'clock is going higher because by 1 o'clock the margin call have been settled. So people have to either add more money to their accounts or they have to sell their positions. Either way, most people have to sell their positions because normally people who have margin call, they have no more funds to invest.
But Sasha, are you saying that margin calls are driving the market down? You're not saying that, right?
On tech stocks, yes. That's
Well,
driver number one.
Well, the market is margined, which is just why there's even more danger. I want to refute what you said because I know you're talking about margin, but I think the key point is this is the most uncertain time the economy has faced in decades, since maybe World War II. So first of all, you see that chart? No,
Yes.
this is going the wrong way since Biden took office, maybe not totally coincidentally. I mean, because he did a lot of this, but some of it was going to happen anyway. But so nobody knows when this curve goes down or how long this goes on, or even if it goes up. Now, we weren't facing this kind of pressure on the market for the last 2 decades, because for the last 2 decades, the Fed has brought rates down artificially, in a way, stimulating the market, because as the Fed goes down, there's no place to put the money. Last year, we were talking about the fact that we didn't know what to do with our cash. We didn't want to buy 1.5% bonds at one point. You could get a muni bond for 1.5%. Well, guess what? Today, I bought my wife a Texas full state bond muni, 3.5% long term. Tax free. That's an alternative that's there that wasn't there before. Now, what if the alternative?
But
So
all this
is uncertain. We don't know nobody knows how long inflation is going to go, what the Fed has to go. The two Larrys, as I've said before, were saying, and I don't think they're right, but they were saying that Fed has to go to 6% or around there approximately, near the inflation rate to control inflation. But
Peter, I agree with everything what you're saying, except that it's all
saying there's a lot of uncertainty, more than ever.
Peter, it's all yesterday's news. Same thing as
uncertainty is not yesterday's news because nobody knows. It's yesterday's
news because it's okay. I'll tell you why. Why? Because market absorb all information there is to it. So if all this happened yesterday, market already absorbs it.
That's
and
the point.
There's already have this information.
But there's no information to absorb, Sasha, because people don't know. That's all they know, which hurts the market. But what if inflation continues longer, if the Fed raises longer? Nobody knows. So there's a lack of information. The theory in MBA school, which was the number one thing I heard in NYU MBA school when I went there, was I heard this probably more than anything. The market absorbs all known information, but this is unknown information. Nobody knows.
It's no information.
I know.
It's not information. It's just anybody's guess. But I'll tell you, I believe in market ability to absorb information. If all this information is valid and a great chance of that happen, Dow today should have dropped 1,000 points or maybe even 2,000 points.
Well, it has dropped a lot, and I've been saying it was going to drop, but I think it's look. There are people today saying this is time to buy. There are people.
I'm not saying that.
No, I'm saying that the market is priced today on what people think, based on known information. But the problem is the unknown information. So what I'm saying is, personally, I think I know better than the market. Now, maybe the market's right, and maybe I'm wrong. But I'm saying that I think that these are, and I think, you know what? And the other point is, I don't buy any publications at all, by the way. I'm just a news junkie. I spend like 40 hours a week reading stuff, and I subscribe to a lot of people who write about particular investments. Like they'll write about.
May I have a minute here?
Yeah, go ahead, Milan.
Sasha is right. Eugene Fama came up with the efficient market theory, which was part of his PhD thesis about 30, 40, 50 years ago. He won the Nobel Prize for it. The market knows all the information that's available. And that's why nobody can have an advantage over anybody. And there are only three ways to beat the market. Number one is dollar cost averaging. Dollar cost averaging works all the time if the source of income is from a job. If the source of income is from the market itself, dollar cost averaging does not work. So, number one way to beat the market is dollar cost averaging guaranteed. Number two way is to ignore one of the 6 habits that I talk about, one or more. And the 6 habits are save, do it yourself, buy the American market as a whole, buy and hold, don't trade, adjust that to your asset allocation, and avoid complexity. Now, you need to ignore one or more of those habits to beat the market, and sometimes it works, and in the short run, it can work. In the long run, it doesn't. And the third way to beat the market, and is the most common way, to beat the market is to keep lousy records and forget your losses and just keep a track of your winnings. Then you can beat the market, and most people do it that way.
Milan, can I ask you a very particular question from your earlier statement when you were discussing the, for example, allocation of 50-50, and if, let's say, a stock going higher, then you sell some and have more cash allocation. When the market goes down, then, of course, you're using your cash allocation to add to stocks. Now, I have a particular dilemma. As you know, I have 2 portfolios. One is a core portfolio of high yield paying dividend stocks, and another one I would qualify as a fund portfolio where I'm using options and many other things. But they're on different accounts, so they're not even supporting each other. My core high yielding dividend stocks, I don't use margin there. They're all paying pretty good dividends. However, using your strategy, I have a dilemma now. I bought a while ago British American tobacco, probably 2 years ago. I don't remember exactly. My price was $35.50 a share. Now today is $45, and it's paying about 7% dividend. It used to pay more, of course, when I bought it. So now it's still paying 7% dividends. So according to your investment wisdom, I would say, I avoid word advice, but wisdom, I can't avoid that. So should I sell partly my position, if not all, but say at least, let's say half of my position in the British American tobacco, and then just keep cash ready if it fall down to say $40 or so to add to this position, or just keep it going? Because
Here's the answer to your question, Sasha.
yes,
The habit number 3 is buy the U.S. economy as a whole by buying an exchange-traded fund that tracks the S&P 500. There are hundreds of exchange-traded funds, thousands. Only half a dozen of them track the S&P 500 accurately. SPY is the oldest and the largest. And so don't own individual stocks. You're going to be right half the time. Every time you buy, either you are right if the stock goes up, or you are wrong if the stock goes down. Both you and the seller cannot be right at the same time. You got a 50% chance of being wrong. Never buy stocks. So if I had in your fund portfolio, you can do whatever you like, experiment, and we recommend that people never have more than 10% of their total assets in a fund.
I have less than 10 actually.
Yeah, that's good, because if you lose it all, you're not going to start eating cat food, right? It won't make any difference to the way you live. So that's what a fund portfolio should be. And most people even don't need a fund portfolio. Just buy the American economy as a whole. Over the last 200 years, it has returned about 10% annually, not inflation adjusted.
Hold on, I have a question.
Mhm.
A really interesting question. If you had bought, and let me throw one last thing. I read that as a preference to the question. I had read that if you bought bonds, treasury strips, like 30 years ago when rates were high, you would have actually performed the market. But have you seen studies that show if you do your 50-50 allocation with stocks and bonds versus 50-50 just with cash and stocks, because you're advocating just keeping half in cash and then pour it into stocks. Of course, that again depends on the markets not being in a 10 or 20 year cycle down, which I think we are in. But based compared to inflation, that is. So, but have you seen any studies between that and like a 50-50 bond cash or a 40-60 versus, in other words, bonds and stocks versus cash and stocks? Have you seen studies how they compare?
Yeah. If your viewers go to Market Watch and look for the Nifty 50-50 asset allocation, and I'm not talking about a Nifty 50 stocks, which were prominent about 30, 40 years ago.
No, the S&P 500 we're talking about, right?
Yeah, that's right. Then that cash does produce a cash drag. But think of this, though. The market's dropped now 20%, and you take cash to rebalance, and then it returns ultimately in the long run. It will, in the short run, the market is dangerous. In the long run, the U.S. market is the
So
safest.
you're saying it has created a cash drag, and
That's right. Yeah, but look what happens when the market drops and you buy it at the drop, a 20% drop.
no, I understand that, but you're saying it
returns,
created a cash drag.
when it ultimately returns back to where it was, that portion of your cash has made that 20%.
Yeah, I understand that part, but overall performance, like if you did your strategy for 20 years versus bonds and cash 40-60 or 50-50, have you seen any studies how they compare? Or there haven't been any studies.
That's right. Yeah, that study that I mentioned, Market Watch, the Nifty 50 portfolio. If you look at that's a study that's very well done, and so you can look at these things by checking Google Scholar, where you have papers which are published by people who are working on a PhD or they live in a publish or perish environment,
Right.
and they have nothing to gain from what they publish personally except keep their job or get their PhD. So if you look there, you will find that the cash drag is more than offset by.
Oh, okay. So that's the answer, that it was, you feel it's more than offset. Of course, there's a number of things in that. One is which stocks you picked in the study, like the Nifty 50 versus the S&P 500.
Don't pick
But the
stocks.
other thing is, we
stocks,
discussed this last week. Tech has done phenomenally. It's 25% roughly of the S&P 500. It hasn't been doing too well lately. And we've been in a great period for the last 20 years. I wonder what happens the other way. Personally, I went to 50% bonds, partly because of your 50% cash thing. I'm like, you know what? So far, it's been good because I locked in bonds at a very high rate. And you know what? If it does well, I'll just reinvest that way. But we are towards the end of the show, and I always like to throw in a dividend stock of the week. And it was very interesting, this one. And also one footnote. I didn't get to the point of why inflation, but I saw one very important thing again. So the energy companies right now are putting in 23% less CapEx than pre-pandemic. But demand for energy in the U.S. particularly is at an all-time high.
Yeah, right.
So, and we've already, a year ago, I saw that USAC on their call said the energy companies have to invest 40% more just to maintain energy production. And Moody's said they need to do 57% more, maybe 3 weeks ago, to get it to be where it is. The energy companies aren't going to be spending that money. Because of the Biden administration, because of the antagonism, because of the fact that they're being regulated, so heavily. They couldn't do it if they can't because of supply chains, and they don't want to because maybe in 20 years they won't be in the oil business anymore. They need to return some of their money. So this is a big problem for the U.S. and we'll see where energy prices go. But my pick this week is in the energy sector. So it's one I've talked to before. Nick loves it. We've all bought in. Some of us at 23, 25. MPLX now is at 31. To me, if I was an investor, I would view the MLP pipeline business as a separate sector because it deserves recognition more than it does. Now, some mutual funds won't get into it because it's taxes, and a lot of people ignore it. It's a little more complicated to do it, but there's a lot of tax advantages for the individual investor. If you own it in an IRA, there's UBTI, which is, you can look it up, UBT. Anyway, so this week, I'm going back to this because I saw Blackstone is one of the biggest companies, very big, successful company. And if I'm reading this right, I'm not sure, but I think I am. Because one of my methods for looking at investment. one of my methods for looking at investments is I always like to look at the big boys. I worked at Wall Street for 17 years, and I've been studying it for 40 years, whatever. I know who the smart money is, Goldman, Neuberger. But Blackstone, I'd say they're probably pretty smart money. So I noticed who was holding MPLX, and I noticed, well, Blackstone is 5% of their assets in MPLX. And then I look at another big holder, and it's Blackstone LP, a limited partnership that probably is owned by Blackstone. So I'm going, Blackstone is 10%, which is unheard of. And I don't understand the relationship between the two, but it's quite possible that they have 10% of their funds in this. It's $1 billion each, by the way, I believe. They have $2 billion in this. They're not dummies. And their next largest, by the way, is in energy is EPD, where they have 5% in there, and that's one of my favorites too. But anyway, so that made me think I should discuss MPLX a little more.
Okay.
9% dividend. It's got a cash flow of price to cash flow of 7 times, so it's earning 14%. The industry before the last 4 years historically earned 17% a year on average. So that dividend of 9% of cash flow doesn't even count the projects that are already invested in that are coming online. So it's also a great thing about the pipelines is that they get FERC adjustments. So the higher inflation is, a lot of their pipelines are adjusted by a government agency. So let's say there's high inflation, they get to raise their rates to keep up with inflation.
Question for you.
Anyway, so that's to me, it has utility-like safety, and it's the bulk of my energy investment, which is about 28%.
Peter, thank you for great presentation. We'll talk next time more about that. In the meantime, I would like to thank everybody for participation in today's show, and have a happy and successful week of trading. See you
Sasha.
next Wednesday. Bye-bye, everybody.
Thank you, Sasha.